Today on The Bottom Line, Ford ousts its CEO. Why? RBC's equity strategist says there's nothing to worry about. And Bitcoin smashes through 2,000. How high can it go?
Hello everyone, welcome. I'm Henry Blodget. This is The Bottom Line. One of the stories this week is we saw the market recover from what we would describe as the Trump impeachment scare last week. Folks got more comfortable that either President Trump is going to be around for a while, or if he is not, that President Pence will take over and have similar policies. So that seems to have calmed things down, along with President Trump's trip to the Middle East, where he has had less time to scare people with tweets and other things like that. But been a good week for the market. We have Jonathan Golub from RBC here today. He is bullish. Says there is pretty much nothing to worry about, so we will dig into that with Jonathan in a few minutes. But before we do that, other news this week, President Trump released his budget for the next 10 years. Happily, it shows the budget balancing. That is very exciting and obviously a good headline. Immediately, of course, everyone dug in and figured out what President Trump wanted to cut and who he wanted to benefit. And as with most presidential budgets, this one has been called dead on arrival because we do not, in fact, live in a dictatorship. So there will be a lot of give and take. This particular budget also prompted a lot of folks to say that some of the assumptions within it are very aggressive and favorable to the budget balancing. Also, some others said that there are some mathematical errors that help it balance. So there'll be a lot of talk about that. But the real key to the budget, as President Trump has been saying for a long time, is the idea that his policies will reaccelerate economic growth. One of the assumptions there is that tax cuts for investors and entrepreneurs will incent them to invest more aggressively than they have. This is one of the things that I would ask you to weigh in on this, but I can tell you as an investor and an entrepreneur, and having talked to many other investors and entrepreneurs over the last few years, the idea that a small reduction in the capital gains tax, for example, will suddenly incent a lot more investment just does not ring true to us. We're talking about a 4-point tax difference. Obviously, everybody would like lower taxes. When taxes get cut, you happily say thank you. But the differences that we are talking about, I would argue, and look forward to hearing from you, in fact, are not going to stimulate any more investment, that there are already big incentives to invest and build companies, so that this will not actually drive that much more. But obviously, a lot more talk about the presidential budget going forward. Another big story, Ford ousted its CEO, Mark Fields, who's only been in the job for 3 years or so. One of the issues that came up when the board members were interviewed is that Fields got into a spat with then candidate Trump about Ford moving jobs to Mexico. This put Ford in the spotlight. It fit very much with candidate Trump's appeal to the idea that companies should only invest in the United States. It was a big PR headache, cost the company a lot of money. There have also been talk about Ford's strategy and, most importantly, its stock price, which has suffered quite a bit under Mark Fields' tenure. Ford strategically is, as Mark Fields often said, they have 1 foot in the present and 1 foot in the future. They are making investments in driverless cars and other technology and trying to keep up with some of Silicon Valley as they do that. But clearly those investments not fast enough for some, and the new CEO, Jim Hackett, apparently is a strong visionary. He's an outsider. The idea is that he'll come in and transform the company much more quickly. But I think this does highlight one of the challenges that all CEOs at traditional companies face, which is that Wall Street tends to be very short-term oriented. It is very hard to, on the one hand, keep your current business cranking and super profitable, and on the other hand, invest aggressively enough to please the visionary investors who are speculating in stocks like Tesla and others, thinking that ultimately that's where the world's going. And Ford has struggled with that. All traditional companies struggle with that, and I think one of the challenges we have as an economy is that we don't give our companies time enough to make long-term investments that aren't going to pay off for 5 to 7 years. As we saw in the case of Ford, CEOs really only have a few years for their strategy to work, and if it doesn't, goodbye, somebody else comes in. Another big story this week, Bitcoin broke through 2,000. That will be our special bottom line segment. So Bitcoin now more than 2,000 would have been inconceivable 5 years ago. In fact, if you had even suggested this, you would have been laughed out town, called reckless and irresponsible and all of those things that folks are called when they look into the future and take any asset and say, oh, it could someday be trading at many multiples of today's price. But what do we know about Bitcoin? So I would say there are 3 points that I would leave you with. And I got to know Bitcoin first about 4 or 5 years ago. I'll tell you that story in a second. But first thing with Bitcoin is this is the perfect asset for a speculative bubble. Why? First, there is no intrinsic value to Bitcoin. And I don't care what arguments people make about how there is intrinsic value and how Bitcoin should be valued as some percentage of global GDP or some relative number to gold. Anybody who's telling you that, put down the Kool-Aid, back away. There is no intrinsic value here whatsoever. The only value is what somebody else is willing to pay for it. And fortunately for those who hold pots of Bitcoin these days, folks seem to be willing to pay a little bit more for it, and ultimately we've driven the prices way up. Second thing about Bitcoin is there is, theoretically at least, infinite upside. Most stocks are usually ultimately tied to cash flow. Apple, most profitable company out there, its stock trades in relation to the amount of cash it generates. Bitcoin doesn't have that problem. If folks decide that Bitcoin should be worth a gazillion dollars a coin, ultimately it can be. There's nothing holding it back. So it is a perfect asset for a speculative bubble. And then the other thing people say is, oh, but those Bitcoin investors, they're nuts. It's crazy. They could lose everything. They could lose everything. There's no question. It could go to zero easily, very quickly. But the math, if you are a Bitcoin speculator, works something like this. The most you can lose is everything, 100%. But the most you can gain, 10x, 100x, 1,000x, all very conceivable. And so when folks who can afford to be diversified and understand it look at that, they say, you know what? I'm going to take those odds. There's so much upside. Maybe I'll lose everything, but wow, if I'm right, I'm right. And that has helped drive the price up. My Bitcoin story, I heard about Bitcoin for the first time about 4 or 5 years ago when I was sitting around a dinner table with a bunch of Silicon Valley entrepreneurs, and they said, Henry, next big thing, Bitcoin. And they were right there with the smartphone and the wallet, and they said, you got to see this. Here it is. It's Bitcoin. And they showed me at the table. They had about $100,000 worth of Bitcoin on somebody's smartphone at that point. And I watched them basically pass it around the table to each other. It's just a crazy sort of value, and it's such an amazing technology, and it can be worth so much. At that dinner, Bitcoin was worth 30. Everybody thought that was insane because it was up from 10 a year or two earlier. Everybody got rich, couldn't go any higher. By the time I got back to New York and Business Insider to write about this, Bitcoin was already 90, began to write about that, wrote a piece called Bitcoin Could Go to $1 Million or Zero, was treated with the usual comments that one gets when one writes a story like that, but explained the logic. Bitcoin was 340 then. It went to 1,200, then it went back to 200, maybe even 190, and now here we are at 2,200. So we are along for the ride. But my belief is that the key for Bitcoin going forward, if it's going to continue to appreciate, is usage. As long as folks are actually transacting in Bitcoin, that is a good sign that the use of Bitcoin and the adoption of Bitcoin is likely to spread. So I think actually this is the most important chart for Bitcoin, which is the transactions per day globally. And what you see is that it continues to increase. It's not steady, quite volatile, but the trend is up. And that very much is a vote of confidence for the fact that people will want Bitcoin and use it going forward. And if that is the case, then the price can continue to go up. And in fact, somebody much smarter than I am, Jeremy Liu, who's a partner at Lightspeed Ventures, which invested in Snapchat and others, very strong, smart venture capitalist, that makes a very compelling and precise case that Bitcoin should be worth 500,000 or more in 15 years per coin. And the way he looks at it is that ultimately let's ascribe a value to every person who ultimately uses Bitcoins and transact in Bitcoin. That, in other words, that you will keep some around, you'll just have it, and so that will control the trading supply of it. And he estimates that 25,000 per user, ultimately, that gets you to $500,000 a coin, given that there should be a finite supply of them. So a specific way of saying, hey, Bitcoin can go a lot higher. So what's the bottom line? My bottom line is Bitcoin could be ultimately worth $1 million or more, or zero, or anywhere in between. We just don't know. It is the perfect asset class for a speculative bubble, and we may be in the middle of one of those. But it is also a useful new tool, and the usage is increasing, and as if the usage continues to increase, ultimately that is a good sign for prices. So with that, We welcome our guest, Jonathan Golub from RBC, Chief Equity Strategist. Jonathan, people talk about the market climbing a wall of worry. I am a worrier in chief. I have tons of worries that I focus on. You say, Henry, there is nothing to worry about.
I mean, listen, there's always something to worry about, but I think people are working way too hard to come up with an argument when we have, the Fed has told us that the chance of a recession in the next year is 6%. In the 9th year of a recovery, that's crazy. That means that the economy is in very solid footing. Earnings in the 9th year of a recovery are now re-accelerating and stronger, and not only in the U.S., we're seeing this everywhere. So the backdrop is really fantastic.
So let's talk about recession.
Right.
What I have learned in 20 years of being an analyst and watching Wall Street and so forth is that recessions are screamingly obvious in hindsight, but when you are looking forward, they're extremely difficult to predict. So the measure you just cited about the Fed saying, hey, there's only a 6% chance of recession, is that actually predictive? I mean, are you comfortable?
If I was using it by itself, it would be helpful but not enough. But here are the things that we know is when you have, before going into recession, you have job growth actually decline. So companies lay off more workers than they add. We're adding something like 175,000 or 200,000 jobs a month. So about over 2 million new jobs a year. That's not remotely close to what would happen if you were to have a recession. Housing activity, not robust, but there's more people buying housing than not. You would see that go in reverse. So housing starts would fall off. We're not seeing that. Manufacturing data is expanding around the world. That doesn't happen. So if you look at when RBC puts out a scorecard of 7 of these items, and if even 1 or 2 of them say you're not going to have a recession, you don't typically get one. And 6 of the 7 are saying perfect green light. 1 of them is a yellow. It really looks very, very positive.
And you, at the beginning of this year, had a target of 2,500 on the S&P, which
Right.
sounded bold then, and was. Congratulations, we're getting very close. Now that we're at 2,400, are you going to update that, or are we sort of saying, yeah, that's pretty much all we're going to get?
We tend not to update our numbers, but we started the year as the most optimistic on the street, and you're right. I got a bit of flack for being too bullish, and now it looks as if I probably undershot in terms of my projection. I think the real key here is as long as we stay away from recession, we're probably in an environment where stocks return like 1% a month, something like 10, 12% plus a year. And if that's the case, I think the more important thing is over the next year or two, we're going to be, well beyond, 2,500, 3,000 and the like, which will be nice to watch.
All right, some other specific concerns. You're not concerned that earnings growth ultimately will stall because wage pressures will rise and companies will pay folks more?
I am, and as actually, we just put out a note on this a couple of days ago when we said that while there's a million arguments that people are making, to raise their caution, there are 2 things that we see as a potential risk that for some reason others aren't paying attention to, and one of them is this issue of rising wages. Now, the first thing happens when we have a 4.4% unemployment rate, which is really terrific, and that pushes wages higher, and that gets people to spend more money. So that's a positive, but at some point, it squeezes profit margins for companies. We think that's going to be a problem, but probably in 2018 and 2019, and we think next year we're going to hear a lot more of a debate on that issue, but it's just too early, and margins are expanding pretty nicely this year, but I agree that will end up being a problem.
The other thing you pointed out, though, is that wage growth is actually good for the economy, which is it gives people more money to spend. It's good for consumers. Maybe ultimately, if we have real wage growth, that can drive some more top-line growth.
Yeah, and it's been somewhat curious that and here's what you have is that because the labor market is tight, some government's report just came out saying that every single sector of the economy is complaining that they can't find qualified workers, and we underestimate how strong the labor market is. So it's not only that wages are going up, but that people's confidence in their ability to find work if they want it is really high. And so you and I were talking about this before offline, that there's this thing called the quits rate, where people voluntarily leave a job because if they know they can get one around the corner, their likelihood of willing to work for a guy who they don't really love goes down. And so those statistics are all telling you people are feeling really great about their job prospects, and that shows up in consumption, and that shows up in broad economic success.
So President Trump.
Yes.
Are you concerned that his economic agenda ultimately won't happen because they can't get it implemented? Does it matter?
Well, so let me start with what is the market telling me, and then I can give you my opinion. We put together a couple of baskets of stocks, and these are stocks that if Trump got everything he wanted, they would be crushing the market. These are companies that win when taxes go down. These are companies that win if America First policies go in. These are companies that win if the industries that he tends to like win. And since Election Day, they're about even with the overall market. Now, they did really well in the first 2 or 3 weeks after the election, and then they've rolled over. So the market right now is really discounting very little, which means this is the way I think that you should see it. If we get stimulative policy that's good for the markets, the market will go up. If we don't get it, the market's not discounting that much. So then the question is, why is the market doing so well if not for Donald Trump? It's really because of better economics.
And if we get into a situation where the Russia probe and other questions about the Trump administration continue, it becomes a big thing that's consuming a lot of energy. Ultimately, what happens to the market then? Okay,
so the first thing that happens is the market, as much as we think that there's a lot of discord and disagreement in DC, if we actually start moving towards some kind of an effort to impeach or something, and I'm not implying that will be the case, but if it were to occur, that's going to really force everything in Washington to screech to a halt, and nobody wants that. So that would be a negative market event. However, once we get beyond that initial shock, it probably ends up proving to be a strong buying opportunity. I mean, you were talking before about how different would Mike Pence's policies be compared to Trump. I mean, ultimately, you still have an all-Republican Congress, Washington, state houses, legislatures around the country. Their agenda for less regulation and lower taxes probably is bigger than Donald Trump.
So you've delivered a very comforting outlook.
Yes.
1% a month into the far future. Last question, what scares you? What would make that wrong?
Well, I mean, part of the reason that in the last year we've had the economy do so well is that you've had a pickup in global, the global economy, and the smoking gun behind that is a better environment in China. In the last year or so, maybe 9 months, activity in China, and you can measure it in their electricity usage or their rail car volumes, things that you can physically see and count, have been picking up very substantially. And if that were to roll over, to a certain extent, that may be the fuel that's driving some of that. So that's one thing. And the challenge with the Chinese data is it's really hard to get your hands around and get comfortable with it. So that's a risk. And the other one you mentioned, which is not a risk this year, but I think will be a risk as we go into the next couple of years, is if the consumer is as good as I think that they will be, there will be some margin squeeze on companies, and that will be an issue. Again, not right now, but over the next year or two, it's going to be a bigger discussion point.
Jonathan Golub, Chief Equity Strategist at RBC. Jonathan, thank you so much. Great to have you.
Pleasure.
Thank you very much, everybody, for joining us. That's the bottom line for this week. Big thank you to Fidelity Investments, as always, for sponsoring and making the show possible. And we will see you next week.